I know when most of us, myself included, honestly, when we hear the word cryptography, we immediately picture something straight out of a Cold War spy thriller.
Oh, yeah, absolutely.
We think of briefcases handcuffed to the wrists of secret agents, or covert underground server rooms, or like shadowy intelligence agencies intercepting static-filled radio messages.
It's always about the cloak and dagger.
Always. But today, we are going to look at cryptography like an open book. Literally. Welcome to the Deep Dive. I'm Satosha.
And I'm Satoshi.
So, to ground us, where does this deep-seated obsession with secrets actually begin?
Well, if we look closely at the research, the best starting point is actually the etymology of the word itself.
Okay, let's break that down.
The word cryptography is a composite of two ancient Greek roots. You have kryptos, which translates directly to hidden or secret,
Right.
and graphene, which means to write. So at its absolute most fundamental core, the very definition of the word is just hidden writing.
Hidden writing, okay.
Yeah, and for millennia, the entire purpose, like the ultimate defining goal of this discipline, was to create and preserve information asymmetry.
Let me stop you right there, because information asymmetry sounds like, I don't know, a dense economics term. What does that actually look like in practice, particularly in an ancient context?
Right, so in practice, it means one party possesses critical knowledge and another party does not, and you want to maintain that imbalance even if the physical message is intercepted.
Like someone grabbing the messenger off a horse.
Exactly. It's about creating a secure, completely opaque domain of confidentiality. And this is not some modern byproduct of the computer age either. We can trace the physical application of this back to 7th century BC Greece.
Oh, wow, that far back.
Oh, yeah. The Spartans, for instance, used a cryptographic device called a sighttail.
A sighttail, how did that work? I am picturing like some kind of complex bronze puzzle box with gears.
No, it was actually remarkably simple, which is what made it so brilliant. A sighttail was essentially just a strip of parchment, or sometimes leather, wrapped tightly in a spiral around a wooden stick.
Wait, just a stick?
Just a stick, yeah, but a stick of a very specific predetermined diameter. The sender would write their message straight across the lever while it was wrapped around the wood.
Oh, I see. So when you unwrap the leather strap from the stick, the letters are suddenly completely jumbled.
Precisely. To anyone intercepting the messenger on the road, it just looked like a normal leather belt with random, completely meaningless letters scattered chaotically across it. The information was quite literally hidden in plain sight.
That is so brilliantly analog. It completely removes the context. I mean, if the enemy captures the messenger, they don't find battle plans. They just find a guy with a really badly defaced belt.
Exactly. They have no idea what they're looking at.
But when the intended recipient gets it, assuming, they actually survive the journey, they take that leather strap and wrap it around a stick of the exact same diameter.
Right. The physical dimension of the stick acts as the decryption key.
And the message just magically lines up perfectly again.
Yes. That physical dimension was the shared secret. And as history progresses, you see this exact same philosophy applied with increasing mathematical complexity.
Right, moving from sticks to math.
Yeah. Move forward a few centuries to Julius Caesar. He famously utilized what we now call a substitution cipher.
The Caesar cipher, right.
Yes, he would shift the entire alphabet by a fixed number of positions. So like an A becomes a D, a B becomes an E, and so on.
Just a straight shift down the line.
Exactly. And he used this specific cipher to securely send battle plans to his generals all across the Roman Empire, ensuring that even if barbarian forces intercepted the scrolls, the strategic truths of his military campaigns remained totally secure.
Because to the interceptor, the scroll is just pure gibberish. The truth of the message is locked behind the methodology of the shift.
Exactly. Fast forward again to the 20th century, specifically World War II, and you see the absolute apex of mechanical cryptography.
The Enigma machines.
Right, the incredibly complex rotor-based Enigma machines used by the Axis powers. These machines were capable of generating billions of possible letter combinations.
Billions.
Billions, yeah. Changing the cipher dynamically with every single keystroke.
And the stakes there were incredibly high. I mean, breaking the Enigma code wasn't just some fun academic exercise. It was arguably the turning point of the entire global conflict.
Oh, without a doubt.
But across all these centuries, from a leather strap in ancient Greece, to a Roman emperor shifting the alphabet, to an electromechanical machine in a global war, the objective was entirely singular.
Yes, the objective never changed.
The research points out that the goal was always the creation of an immutable secret. It was the science of generating what the research explicitly calls the private truth.
That phrase, private truth, is the absolute cornerstone of everything we are discussing today. And what's truly fascinating is how seamlessly this paradigm of the private truth carried right over into the modern digital age.
Right, because computers didn't change the goal, just the method.
Exactly. When digital computing exploded in the late 20th century and the internet began to connect global networks, we didn't abandon the concept of the CyTale or the Enigma, we just digitized them. We developed highly sophisticated encryption algorithms.
Because the internet itself is basically a giant public town square,
Yeah.
right? If I send an email, it bounces across dozens of open servers before it ever reaches you.
Right. The underlying infrastructure of the internet is inherently transparent and highly permissive. So, to conduct private business, we had to invent ways to hide our data in plain sight, just like the Spartans did with the belt.
It's the exact same problem.
It is. We created symmetric systems where two parties share a single digital key, and later asymmetric systems like public key cryptography, which uses a mathematically linked public and private key pair. We built protocols like SSL and TLS.
I know those acronyms.
Sure.
For you listening, SSL and TLS are the protocols that give you that little reassuring padlock icon in the corner of your web browser when you are typing in your credit card number.
Yes, that padlock icon is the literal visual representation of a private truth. These cryptographic primitives were engineered to establish secure, opaque tunnels through the open internet.
Tunnels through the noise.
Exactly. The primary overriding objective remains stubbornly rooted in absolute confidentiality.
Okay, I want to make sure I am fully grasping the mechanics of this historical paradigm before we, flip it entirely on its head.
Go for it.
Here is how I'm picturing traditional encryption. Tell me if this works. It's like sending a locked, highly durable steel briefcase through an incredibly crowded, chaotic room.
Okay, I like that.
Everyone in the room can see the briefcase moving from person A over to person B.
Yeah.
The fact that a transaction of information is happening is totally public.
Right, the movement is visible.
But only the sender and the recipient possess the physical key required to open that briefcase and actually see the truth inside. To everyone else standing in the room, the contents are completely inaccessible.
Completely.
They have no idea if that steel briefcase contains nuclear launch codes, a recipe for chocolate chip cookies, or like a bearer bond for $1 million. It is just a void of information.
That is actually a very precise analogy. The truth, the data, the value definitively exists inside that briefcase, but it is entirely cordoned off from the public sphere.
Right.
It requires a closed, permissive system where access is entirely synonymous with decryption. The cryptography acts as a protective shell.
But this raises a massive fundamental question. If our entire history is built on hiding things, if the creation of this private truth is the gold standard for human communication, military strategy, and financial organization, why do we even need to hide things so desperately in the modern economic world?
What do you mean?
Well, we aren't all fighting World War II or coordinating Roman legions. Most of us are just running businesses.
Right. Well, if we want to connect this to the bigger picture of modern society, we have to examine the fundamental nature of human organization itself.
Okay, lay it on me.
We have to look at the economic life cycle of any functioning entity, whether that is a massive multinational corporation, a local small business, or even a sovereign nation state.
They all operate the same way, fundamentally.
On a base level, yes. According to the research we are analyzing, organizations exist to execute a very specific two-step process. First, they must raise fiat, and second, they must convert that fiat into capital.
Okay, I really want to break that down, because fiat and capital are terms that get thrown around on financial news networks constantly, often interchangeably, and I think it creates a lot of confusion.
They are definitely not the same thing. Let's start with fiat. Fiat is your currency. It's your operating liquidity.
Cash on hand.
Exactly. It is immediate, transient purchasing power. Organizations raise fiat in various ways, right? Through debt issuance like corporate bonds, through selling equity or shares, or in the case of sovereign governments, through taxation and inflation.
Yeah, you get the cash however you can.
But here is the critical point. Holding fiat is never the ultimate goal of a successful organization. Fiat inevitably loses value over time.
Because of inflation.
Yes. So the primary existential objective of an organization is to strategically and efficiently convert that raised fiat into capital.
So if fiat is the fuel, capital is the actual engine.
That's a really great way to put it. Capital represents the actual assets accumulated on a balance sheet that hold weight, generate revenue, and project greater value into the future.
Let's make this super concrete. Can we look at some real-world examples of that fiat-to-capital pipeline in action?
Sure, think about a massive tech conglomerate like Google. They raise billions in fiat to fund massive, sprawling research and development departments.
Right, burning through cash.
Yeah, they pay salaries, they build data centers, they run endless servers, that's all burning fiat. But they take that effort and convert it into a proprietary technology moat, patented algorithms, and intellectual property.
And that IP is the capital.
Exactly. That intellectual property is their capital.
Okay, what about something more physical, like real estate?
Yeah, consider a real estate investment trust, a REIT. They raise fiat from their shareholders, right? And they use that liquidity to acquire physical land and commercial properties.
They buy a shopping mall.
Exactly. The fiat is spent, it's gone. The land and the buildings are the capital that generates yield. Or consider a massive mining corporation. They convert their operating fiat into heavy machinery, labor, and diesel fuel to extract physical gold out of the earth.
The giant yellow dump trucks.
Right, the trucks are the expense, but the gold sitting in their vault, that is the accumulated capital.
Okay, so raising fiat is just the necessary mechanism, but accumulating capital is the actual destination. You exist to build that balance sheet.
Yes, and here's where the brilliance of the research's duality really comes into focus. There is an immense, almost irreconcilable tension between the daily granular operations required to acquire that capital and the capital itself.
Attention, how so?
Well, operations demand absolute privacy. They demand that traditional private truth we were just talking about with the steel briefcases.
Because operations are inherently messy, and let's face it, the business world is ruthlessly competitive.
Absolutely. Think about those R&D pipelines. The intricate supply chain logistics, the unannounced corporate acquisitions, or national security maneuvers, these are lifeblood trade secrets.
You can't just tweet out your corporate strategy.
No. No rational company wants its daily, granular financial history broadcasted on a public network. If Google's competitors could see every single dollar they spent on a secret artificial intelligence project in real time, Google would lose its competitive advantage instantly.
They would be front run on every single decision.
Exactly. Operations require the steel briefcase. You must hide the mechanics of your success.
I completely agree with that, but I'm going to push back here, or at least play devil's advocate for a second.
Okay, let's hear it.
If privacy is so incredibly vital for a company or a country's survival, if operations are the vulnerable underbelly, why would any entity ever want to show their cards to the world at all? I mean, why not just keep everything from top to bottom a complete, impenetrable secret forever? Just stay in the shadows and quietly accumulate.
Because while operations desperately need privacy, capital accumulation fundamentally demands exhibition.
Exhibition.
Yes. This is a crucial, non-negotiable distinction in economics. You cannot just hoard your wealth in a dark room if you want your organization to actually grow. You have to show off your bloated balance sheet to signal strength, to signal solvency, and to project dominance to the broader market.
Ah, I see. Because if you don't show everyone how much capital you have successfully accumulated, nobody will trust you enough to lend you more fiat.
That is exactly the point. You have to constantly prove you are wealthy so you can raise more money on better debt terms or at higher equity valuations to continue the cycle of growth. It is a constant, endless loop.
So you fiercely hide the recipe, but you are absolutely forced to exhibit the cake.
Yes, hide the recipe, exhibit the cake.
You know, it's funny you mentioned the compulsion to exhibit things you've accumulated because we suffer from the exact same condition.
Oh, we definitely do.
We are incredibly eager to show off the accumulated research that fuels these deep dives. We can't be more thankful that you all are as fascinated by these explorations into complex topics as we are.
It's amazing to see the response.
And honestly, we think the primary reason for that connection is the depth of the research we share directly on our website.
It really is the foundation of the show. And we've structured it so there is absolutely no friction for you. No login needed, no cookies tracking your behavior, and absolutely no advertisements cluttering page.
Not at all.
Exactly. So please, if you want to dig deeper into the actual documents and the mechanics of this architectural inversion we are discussing today, check the link in the descriptions. The full research is just waiting for you.
It's an absolute goldmine of context. So back to this massive tension. Hide the operations to survive, exhibit the capital to grow.
Right.
For thousands of years, as we establish, Cryptography was exclusively used for the hiding part. The side tail, the Enigma, SSL.
The steel briefcase.
Right, the steel briefcase. But then the timeline hits late 2008. The research isolates this as the turning point. Enter a pseudonymous entity named Satoshi Nakamoto and a 9-page white paper that effectively changes the trajectory of computer science forever.
Yeah, and the 2008 white paper was originally pitched to a cryptography mailing list as just a peer-to-peer electronic cash system.
Right, just internet money.
But the research we are diving into argues that this architecture actually birthed something far more profound than just internet money. It birthed a perfectly verifiable digital capital network.
Wow.
And it achieved this by fundamentally subverting the cryptographic paradigm we just spent the last half hour exploring.
This is what the research calls the architectural inversion. And this is the concept that really, truly broke my brain the first time I read it.
It's a tough one to wrap your head around at first.
It really is. Because instead of using cryptography to obfuscate and hide, the Bitcoin network uses it to authenticate an open statement.
Yes. It takes the precise mathematical tools of cryptography, specifically cryptographic hash functions and digital signatures, and instead of using them to conceal information inside a steel briefcase, it weaponizes them to expose information to the absolute maximum degree possible.
It just blasts it out there.
Literally. It systematically separates the cryptographic concepts of authentication, structural integrity, and non-repudiation from the concept of confidentiality.
It's just wild to pause and think about the sheer audacity of that conceptual leap. You have an entire academic and military discipline honed over millennia, fiercely dedicated to secrecy.
Yes.
And this system just deliberately discards confidentiality. It throws it entirely out the window in favor of absolute transparency and systemic integrity.
It's a complete 180.
It transforms cryptography from a machine that generates an immutable secret into a deterministic engine that generates an immutable open statement.
And that specific phrase, immutable open statement, is the absolute key to understanding the network.
Okay, define that for us.
It means a truth that is universally visible to everyone on the network, that mathematically cannot be forged, and that cannot be denied or reversed by the person who made it. It is a public declaration of reality.
But practically speaking, how? I mean, if it's completely open, how does it actually work without everyone just stealing everything? Because if there's no encryption hiding my money, what is protecting it from a hacker? I really need to understand this structurally, but I have to warn you, if you start reading mathematical formulas, my eyes are going to glaze over.
Fair enough, yeah. No complex math, I promise.
Thank you. Let's look under the hood, but keep it accessible.
Okay, to prove this transparency, the research provides a conceptual analysis of the actual Bitcoin Core C++ code base.
Okay, we are getting into the code.
Just conceptually, it specifically focuses on a foundational software class called C transaction. Now, in object-oriented programming, a class is basically just a blueprint for an object.
Right, like a template.
Exactly. The C transaction class is the primary structural object for interacting with the entire network. Everything revolves around it. And what the research emphasizes heavily is that within this fundamental data structure, there is absolutely zero encryption for data in transit or data at rest.
Wait, zero encryption, none?
None. Zero.
So when I use my wallet app on my phone and hit send on a transaction, I am not sending a locked steel briefcase through the internet.
Not at all. A transaction is not a transfer of encrypted balances within an opaque, protected database. It is an open, globally broadcast text statement.
Okay, my mind is slightly blown.
Let's break down the functional components of this statement so you can see how it secures value without hiding it. First, inside C transaction, you have the coup point.
Wait.
This is a reference to a specific output from a previous transaction. It consists of a previous transaction ID and an index number, and it is completely in plain text.
Okay, let's build an analogy here because I need to visualize this. If it's in plain text, then the coup point is basically a highly specific, universally visible treasure map.
I like that.
It shows every single person monitoring the network exactly where the funds originated from. It points directly to the exact location of the value on the public ledger.
That's a fantastic way to visualize it. It's a map pointing to the exact coordinates of the value. Next, you have the CTXN, or the transaction input.
Okay, what does the input do?
This component contains that treasure map data we just mentioned, but crucially, it also contains the cryptographic signature proving authorization to actually move those referenced funds.
And let me guess, this signature is also not encrypted.
Nope. This signature is a plain text binary string.
Okay, keeping with the visual analogies. If traditional cryptography is that locked steel briefcase, the CTXE signature is like leaving your unique, unforgeable digital fingerprint on a brilliantly lit, heavily armored glass display case.
Oh, that's good.
Everyone in the entire world can walk right up to the glass, look closely at the fingerprint, and mathematically verify, yes, that fingerprint undeniably belongs to the rightful owner of this specific asset.
Exactly.
The proof of ownership is absolute, but absolutely nothing is hidden from view.
The glass display case is the perfect mental model. Finally, to complete the transaction, you have the CTX out, or the transaction output.
And what's in the output?
This section contains the precise numeric value being transferred, so the actual amount of Bitcoin and the scripting opcodes.
Okay, you lost me slightly at scripting opcodes. What is an opcode functionally?
An opcode is essentially a mathematical condition or a set of rules. It dictates the precise criteria that must be met to spend those specific funds in the future.
Like a programmable constraint.
Exactly. And again, these opcodes are entirely in plain text.
So, tying it all together, the CTX out is like a completely transparent piggy bank.
A transparent piggy bank, yes.
You can look right through the glass and count the exact number of coins sitting inside. But attached to the top of this transparent piggy bank is a visible, mathematically verifiable combination lock. And that's the opcode.
Right, the rules for opening it.
Everyone can see the lock, everyone can count the money inside, but the rules state the lock can only be opened if you possess the corresponding private key to generate the next valid fingerprint.
Precisely. When you synthesize all these plain text components, so the map, the fingerprint, the transparent piggy bank into the aggregate C transaction structure, you realize what is actually happening on a systemic level.
You aren't moving money at all, are you?
No. You are not moving digital coins through a secret encrypted tunnel. You are publicly broadcasting a declaration to the globe that says, I am definitively destroying the old cryptographic lock that previously secured this value, and I am simultaneously creating a brand new cryptographic lock, and here is the mathematical proof that I have the authority to do so.
Man, it truly is the ultimate open statement.
It really is.
But, exploring this brings us to the obvious glaring elephant in the room.
Which is?
Well, if everything is completely unencrypted, and this entire ledger is fully visible to thousands of mutually suspicious computer nodes all around the world, none of whom know or trust each other, what prevents someone from spending the exact same transparent coin twice? I mean, if I have a digital asset and it's just a transparent digital statement, what stops me from sending that exact same statement to you to buy a car and simultaneously sending it to someone else to buy a house?
You've just described the famous double spend dilemma.
It seems like a massive flaw.
It was. Solving this problem without relying on centralized encryption or a trusted third party like a bank or a credit card clearinghouse was the absolute holy grail of computer science for decades.
Nobody could figure it out.
Right. And the solution Bitcoin introduced relies on the synthesis of two concepts, the UTXO model and thermodynamic consensus. Let's start with UTXOs, which stands for unspent transaction outputs.
Right, because I think a huge point of confusion for people is that Bitcoin doesn't actually have accounts or balances in the way a traditional bank does.
It doesn't, and that distinction is vital. Your traditional bank tracks your wealth via an ongoing ledger. It adds a number to your balance cell in a database when you deposit and subtracts from it when you withdraw.
Right, it's just a fluid spreadsheet.
Exactly, it's fluid. Bitcoin operates strictly on discrete, indivisible outputs. Every single unit of Bitcoin in existence is a specific UTXO locked by a slot.
Here is how I process the UTXO model, because the spreadsheet analogy completely fails here. It's not a ledger adding and subtracting abstract numbers. It's more like taking a physical solid gold coin.
Okay, I'm following.
When you want to spend it, you walk out onto a public stage, you melt that solid gold coin down completely into liquid gold in front of a massive watchful audience, and then you immediately cast a brand new coin, or maybe multiple smaller coins, from that exact same liquid.
Right.
The old coin is physically gone. It has been irreparably destroyed.
Yeah.
The new coins are what exist now.
That is exactly the mechanism. And because the old coin is literally destroyed in the code base during the process of the transaction, you inherently cannot spend it again. The protocol's strict, inflexible rules dictate that a UTXO can only be consumed once.
It is a one-time use cryptographic object.
Yes, exactly.
Okay, I understand the destruction part. But what if I try to be incredibly sneaky? What if I broadcast two validly signed transactions, attempting to melt down the exact same gold coin, to two different merchants at the exact same millisecond.
Trying to beat the system.
Right, I'm trying to trick the network before it registers the destruction.
Well, the network anticipates this and handles it in specific stages. The first line of defense is the mempool, which is short for the memory pool.
The waiting room.
Basically, yeah. When you broadcast those two conflicting transactions, the thousands of individual nodes scattered across the network receive them at slightly different times due to simple network latency. You know, the time it takes data to physically travel through fiber optic cables.
Right, speed of light stuff.
Exactly. A node will accept the very first mathematically valid transaction it sees into its mempool. When your conflicting duplicate second transaction arrives a split second later, the node checks its mempool, sees the conflict, instantly rejects the second transaction, and completely refuses to relay it to anyone else.
So the nodes running the mempool act like giant, ruthless bouncers at a nightclub.
That's exactly what they do.
You show up with a valid ID, they let you into the waiting room. A millisecond later, someone else shows up with an exact duplicate of your ID trying to get into the same club, and the bouncer just immediately throws them out on the street. There are absolutely no duplicate IDs allowed in the waiting room.
That handles 99% of double spend attempts right there.
But what about the 1%?
We have to consider the edge cases. What if, despite the bouncers, your two conflicting transactions make it to two different miners in completely different parts of the world at the exact same time?
Oh, like one in Tokyo and one in New York.
Right. And what if both of those miners decide to include your conflicting transactions in their respective blocks, and they both simultaneously try to add their valid block to the blockchain?
Here's where it gets really interesting. Because in a traditional system, a central boss, like a clearinghouse CEO or a central bank, would step in and declare which transaction is valid.
Right, a referee.
But here, there is no central boss to say which miner is right.
This is where we reach the physical limitations of reality. This is thermodynamic consensus.
Thermodynamic consensus. Sounds heavy.
It is. To actually add a block of transactions to the chain, miners must solve an intensely difficult cryptographic puzzle using a SHA-256 hash function.
Let's pause on the hash function for a second. Without the math, what is the miner actually doing?
Conceptually, a hash function is a one-way mathematical meat grinder. You put data in, and it spits out a completely random string of numbers and letters.
Okay, a meat grinder.
The puzzle the miners are trying to solve requires them to find a specific output that starts with a certain number of zeros. Because the output is entirely random, there is no shortcut, there is no algebra you can use to solve it.
You can't cheat the puzzle.
No. The only way to find the right answer is to guess. Over and over and over again, trillions of times a second.
So it's basically a global lottery.
Yes. But here's the catch. Every single guess requires the computer processor to execute a cycle, and every cycle consumes a tiny amount of electricity.
Right, it takes power.
To guess trillions of times a second requires massive industrial amounts of computational energy. This is proof of work. The work is the expenditure of physical energy.
So, back to our conflict. What happens with the two blocks?
If two miners solve the puzzle at the exact same moment with conflicting blocks, we get a temporary network fork. Two parallel realities of the ledger exist for a brief moment in time.
A literal fork in the road. So how does a decentralized network with no leader choose which reality is the definitive truth?
It resolves the conflict through the physical laws of thermodynamics via what is called the longest chain rule.
The longest chain rule.
The network doesn't panic, it just waits. The thousands of miners around the globe will look at the two forks and start trying to solve the next block, building on top of one of them. Whichever of those two parallel blocks is mathematically extended first by the network, meaning another miner found a solution and linked it, becomes the absolute truth.
Then the other one.
The shorter, slower chain is immediately orphaned and discarded by every node. Any transactions unique to that discarded block, including the losing half of your double spend attempt, are completely invalidated as if they never happened.
That is profound when you really think about the implications. It's not a board of directors voting in a boardroom on what is true.
No humans involved in the decision.
It is the network naturally aligning behind the chain that has the most accumulated, undeniable, verifiable physical energy poured into it. Time and energy literally become the arbiter of truth.
That is the absolute crux of the research. The public ledger isn't just a spreadsheet in the cloud. It is firmly anchored to the physical world through the demonstrable, irreversible expenditure of real energy.
Wow.
That thermodynamic anchor is what makes the historical record completely immutable without ever needing an encrypted private database.
The sheer amount of energy and intense coordinated effort that goes into creating something of lasting, unassailable public value is just staggering. It takes actual work to create truth.
It really does.
And honestly, it actually reminds me a lot of the energy you, the listener, spend supporting and sharing knowledge within your own communities. When you find a concept that changes your perspective, it takes energy to synthesize it and pass it on.
Definitely.
And if this deep dive is sparking those kinds of thoughts, if this exploration of thermodynamic truth is making your brain spin in a good way, we request you to share the show with your friends or wherever you geek out on deep topics of deep finance or cryptography.
We truly rely on that collaborative sharing. You can share our links. We request to Fountain.fm, Spotify, Apple Podcasts, or YouTube Music. All the links are on our research website. Link in the description.
And as for videos, we have started using Mosaic for small videos and YouTube shorts. Please take a look and let us know what you think, because we think it is a great tool for small creatives like us.
It really is. We can feed it a YouTube link, and it creates beautiful AI-based cinematic captions, infographics, and a whole lot more we're still discovering in our capability tests. It's a fantastic tool.
It's been a total game changer for our workflow. So we've deeply explored the technical mechanics, right? The unencrypted C++ code base, the transparent piggy banks with combination locks, the mempool bouncers, and the thermodynamic lottery that anchors the truth.
We've covered a lot of ground.
We have. But now we need to transition into the so what. What does this architectural inversion actually mean for society and how businesses function?
Yes, the research pivots beautifully here. It moves from the rigid technical architecture to the profound sociological and philosophical implications.
Okay, let's get philosophical.
It focuses specifically on an epistemological shift. Epistemology, for context, is the branch of philosophy concerned with the theory of knowledge, like how we know what is true and how we justify that belief.
How we know what we know.
Exactly. In this context, the research introduces two incredibly vital, contrasting concepts: table truth and public truth.
Okay, let's unpack these two specific truths, because they seem to frame the entire modern economy. What exactly constitutes table truth?
Table truth is the messy, unvarnished internal reality of an organization. It's the raw data sitting on the conference room table behind locked doors. It perfectly aligns with the private truth we discussed in the very first segment. If you are a global supply chain company, your table truth includes the proprietary, highly sensitive algorithms routing your cargo ships.
Right.
It includes the localized security vulnerabilities in your regional warehouses. It includes the unannounced strategic acquisitions you are secretly planning for the next fiscal quarter.
And you definitely don't want anyone seeing that.
Exactly. This privacy isn't nefarious, it is highly functional. It is absolutely necessary for operational survival.
It's the steel briefcase of operations.
Yes.
And public truth.
Public truth is the highly curated, meticulously manicured statement that the entity deliberately presents to the outside world. It is the glossy quarterly earnings report.
The PR spin.
Exactly, the carefully worded press release. It is the audited balance sheet designed to build trust with lenders, satisfy anxious shareholders, and project an aura of unwavering strength to the market.
So, we have the chaotic, messy, highly secretive reality sitting on the table, and the shiny, polished brochure we proudly hand out to the public.
Right.
Historically, there has always been a massive problematic gap between those two things. I mean, we know companies lie. We know they massage the numbers.
All the time.
And to bridge that gap of trust, society has had to rely on friction-heavy, highly compensated, trusted third parties. I'm talking about massive global auditing firms, bureaucratic regulatory bodies, and government inspectors.
The middlemen.
Right. We literally hire armies of accountants to come in, pore over the books, and swear under penalty of perjury on a stack of legal documents that a company's glossy public truth actually matches its internal table truth.
Exactly. And this creates what the research calls the auditor dilemma.
The auditor dilemma.
Yeah. To verify your public standing, you are forced to invite these third parties directly into your most private domain. You have to expose your highly sensitive table truth, your raw operations, to the auditor, crossing your fingers and trusting that they won't accidentally leak your operational secrets.
Or use them for insider trading.
Right. Just so they can stamp your public truth as valid for the banks. It is incredibly inefficient, deeply expensive, and as history has shown with catastrophic corporate failures like Enron, it is highly prone to human corruption or simple systemic error.
Which brings us directly back to the architectural inversion of Bitcoin. How does a network of transparent data structures and thermodynamic energies solve the auditor dilemma?
By bypassing the auditor entirely,
Just cutting them out.
it renders them completely obsolete for this specific function. Through the application of proof of work and the unencrypted, globally visible ledger, a transaction instantly transforms into an undeniable global public truth without needing a human to swear by it. The research states that Bitcoin provides a fundamental mechanism where the capital aspect of an entity's balance sheet, the stored wealth, can be independently and globally verified as an absolute public truth, without ever requiring the entity to expose its operational table truth to anyone.
Let me make sure I am fully grasping the magnitude of this.
Yeah.
Think about it this way. If a massive multinational corporation decides to hold Bitcoin as their primary treasury reserve asset, they can globally verify their accrued capital instantly, at any moment of the day.
Yes, instantly.
Anyone in the world, a bank, a shareholder, a competitor, can look at the public blockchain, check the cryptographic signatures, and mathematically verify, yes, this company definitively holds exactly this amount of wealth.
The ledger is the absolute reality.
The company doesn't need to hire a Big Four auditing firm to prove they have the money. They don't have to show anyone their sensitive R&D budget, their payroll records, or their supply chain vulnerabilities to prove their solvency.
No, they don't.
They maintain absolute, impenetrable operational privacy, their table truth, while simultaneously achieving mathematically perfected, friction-free capital exhibition, their public truth.
You've nailed it. It perfectly balances the sociological dichotomies between the private domain and the public sphere. It allows the globe to instantly verify an entity's accrued capital without needing to trust a single human intermediary.
It replaces subjective trust with objective mathematical verification.
Exactly.
Well, if this system so perfectly bridges that historical gap between private operations and public exhibition, we have to ask the ultimate question.
What's that?
We have to compare it to the alternatives. How does this transparent thermodynamic digital capital actually stack up against the traditional assets humanity has been using to store and exhibit wealth for centuries?
To answer that objectively, we have to evaluate the inherent friction in traditional capital assets.
Okay, let's do it.
Let's look at the cornerstone of global wealth, real estate. Acquiring land and constructing commercial properties is the classic time-tested way organizations store capital.
Right, everyone wants property.
But look at the friction. It requires massive upfront capital expenditure, years of navigating bureaucratic zoning laws, and endless construction delays. And crucially, the true market value of that asset is completely theoretical until a definitive sale occurs.
Right, you might look at your spreadsheet and think your new skyscraper is worth $1 billion, but you don't actually know its value until a buyer writes the check and clears the bank.
Which could take decades.
It's highly illiquid, incredibly localized, and the valuation is totally opaque.
What about intellectual property? We talked about Apple or Google's technology moats earlier. That's capital.
True, but IP is arguably even harder to value objectively than real estate. Its value can only be accurately gauged in retrospect, usually during those quarterly earnings reports, based on how much actual fiat revenue it managed to generate.
So it's looking backwards.
Yes. It relies entirely on the flawed auditor paradigm we just dismantled. You are basically trusting the company's internal accounting of how valuable their own idea is. And then, of course, there's the historical heavyweight champion of capital, physical gold. Gold is the original capital asset precisely because it is physically scarce and requires thermodynamic work mining to acquire.
But, as the research astutely points out, gold suffers from a fatal flaw in the modern era, which is pseudo-scarcity.
Pseudo-scarcity?
Yeah. Its scarcity is entirely dependent on the current limitations of human engineering and extraction technology.
Right. I always find this dynamic fascinating and, frankly, a bit hilarious because gold operates on a sliding scale of effort.
What do you mean?
As the fiat price of gold rises during an economic crisis and it becomes more valuable, it suddenly becomes economically profitable for mining companies to invest massive amounts of fiat into inventing better technology to dig deeper into the Earth's crust.
Oh, absolutely.
They can process lower-grade ore that was previously completely ignored. And eventually, as technology continues to advance, we won't just be digging deeper. We will be dealing with automated deep-sea mining, or literal asteroid mining.
Asteroid mining is a real possibility.
There are asteroids in our solar system containing more gold than has ever been mined in human history. The moment it becomes profitable to capture one, the supply of gold will hyperinflate. Gold is only scarce until it becomes profitable to find more of it.
which fundamentally undermines its role as an absolute store of value over a long enough time horizon. This is exactly why the research contrasts all these traditional friction-heavy assets with Bitcoin, ultimately labeling it the apex asset.
The UPEX asset.
Unlike real estate, which takes years of bureaucracy to fructify, acquiring and verifying Bitcoin is near instantaneous. And unlike IP or gold, its price discovery is mathematically perfect.
Because it's always trading.
Exactly. It trades continuously, 24 hours a day, 365 days a year, across dozens of global fiat systems simultaneously. It provides a minute-by-minute, cryptographically undeniable proof of exactly what that accumulated capital is worth everywhere in the world without relying on an auditor's delayed opinion.
I know a listener out there is thinking, but Bitcoin is volatile. How can it be the apex asset if the price swings wildly?
It's a common critique.
But based on everything we've discussed, that volatility isn't a bug. It's a feature of its perfection. That volatility is the real-time, unmanipulated price discovery happening in an open market, without central banks stepping in to freeze trading or artificially smooth the curve.
Right. It's the raw truth.
It is the raw truth of supply and demand interacting every second. And that brings us to the grand finale of this research, the absolute mic drop of the architectural inversion, the hard cap.
21 million units.
21 million units.
Yes.
That is the absolute scarcity mathematically locked into the protocol. It cannot be diluted by corporate competitors building a better version. It cannot be mined from space rocks by future trillionaires trying to inflate the supply.
Nope.
And because the ledger is a transparent public truth, because everyone can see the transparent piggy banks, it cannot be secretly over-leveraged by corrupt fractional reserve banks. It is the perfect, unprecedented marriage of absolute, code-enshrined scarcity and immediate public verifiability.
If we step back and look at the big picture recap of the journey we've taken today, humanity spent thousands of years developing cryptography to hide information, to secure the private truth from enemies and competitors.
Right.
In 2008, that millennial-old paradigm was completely inverted. By taking those exact same cryptographic tools, hash functions, and digital signatures, and using them to authenticate open statements rather than obfuscate them, and by firmly anchoring those open statements to the unforgeable physical reality of thermodynamics, we transcended the original goal of creating mere electronic cash.
You really did.
We successfully engineered perfected digital capital.
We took the ultimate secret-keeping weapon, honed by spies and generals, and used it to systematically destroy the very concept of financial secrets. It is a staggering achievement in human coordination and game theory.
It truly is.
As we wrap up this deep dive, we want to leave you with a final, slightly provocative thought to mull over as you go about your week.
Okay, lay it on them.
If an organization's, or even a sovereign nation's, ultimate power comes from perfectly and undeniably exhibiting their capital to the world, what happens to traditional sovereign states when they can no longer hide their balance sheet weaknesses behind opaque, traditional table truth accounting?
That's a heavy thought.
When the whole world eventually demands cryptographic public truth, who survives the transition?
That is undoubtedly the geopolitical question of the century.
We want to thank you all so much for joining us on this intellectual journey today. If you found value in this exploration, we'd love for you to subscribe to the show on your favorite platform.
Please do.
And please invite your friends to comment and join the mission of collaborative intelligence. We thrive on the dialogue. Specifically, if you have deep expertise in the history of cryptography, if you study macroeconomics, or if you are fluent in C++ coding and want to elaborate on the code-based mechanics we discussed, we would love to see your insights in the comments section.
Let's figure out the edges of this new paradigm together.
The transition from private truth to public truth is just beginning.
Yeah.
And understanding the architecture is the first step. Keep searching, keep the quest on. See you on the next deep dive. I'm Satoshi.
And I'm Satoshi.